Hi, I'm Ken Carpenter. Welcome to Invest AI Savvy, where AI powers smart investing. Today we're going to talk about a port in the storm, or the safest place to put your money, your investment funds, your retirement, your nest egg in case of calamity, in case the economy looks like it's going south, in case market fluctuations are scaring you. And right now, the markets are fluctuating quite frequently. So we're seeing a lot of ups and downs in market valuations, in bond valuations, and as well as ups and downs in the dollar. So today, just for context, is June 3rd, 2025, as you could probably see on the screen. So the idea is that sometimes you don't want to be invested, you just want to be safe. And that's why going to the bank with your money is sometimes the most prudent thing to do, or sometimes the thing that will make you feel the safest. And sometimes investing means that you have to stomach fear of loss. But when your money's in the bank, that fear of loss could be mitigated quite a bit, hopefully. So what we're going to talk about are some bank accounts that pay more than you would normally get in your typical savings or checking account. So we're going to be focusing on certificates of deposit and high yield savings accounts, because these type of accounts will typically pay quite a bit more, relatively speaking, than you would be earning in your standard community bank or nationwide bank savings account, as I just said. So today we're going to take a look at the Wall Street Journal to look up those rates and see what's actually available. Okay, so right now, Wall Street Journal has had over the years multiple ways of listing these rates, but as of today, June 3rd, 2025, the Wall Street Journal will place these rates in an area of the journal online called the buy side, right? So if you visit the buy side for the Wall Street Journal, you're going to find all types of offers. Now, one thing please don't forget about, and this is very important, we've got Father's Day coming up on, I believe it's June 15th. So it's one of the most important holidays of the year. And the buy side at Wall Street Journal will give you some great gift ideas for dad. But I digress. I'm sorry. If we scroll down a little bit here, we can see that under the personal finance heading, we've got CD rates and high yield savings rates, or high yield savings account, HYSAs, right? People are more familiar with the term CD, and that's because CDs pay a little bit more than a high yield savings account because they have more terms and conditions. There are more stipulations on your money. So let's take a look at the CDs first, okay? Now, as I probably already mentioned, CD stands for a certificate of deposit. So a certificate of deposit, the primary two stipulations or terms and conditions of depositing your money in a certificate of deposit is that there's a minimum time frame that the money has to stay invested in the account, number one, and number two, there's a minimum account size, right? So if I walk into, let's just say hypothetically, I walk into Eagle Bank and I say, hey, I've got $10 that I want to open up a CD with. they're not going to go for it. They're going to go, Mr. Carpenter, if you want to open up a CD at Eagle Bank, that's going to cost you a minimum of $1,000, okay? And that's a 24-month CD. So I'll hand him the $1,000 with the idea that that $1,000 minimum account size will be tied up for 24 months minimum. That's not to say that I can't get the money back. Like, let's say I've got some kind of a plumbing emergency, or my 1992 Chevy Nova breaks down, and I've got some car repairs, and I go into Eagle Bank and I say, hey, I need to get the money. They'll give me the money, but there will be a certain penalty that they will levy, so I won't get the full $1,000 back. This is all in the account terms and conditions when you sign up to open up the account. So there's no surprise there, as long as you read all the paperwork when you open up the account. So certificates of deposit are a little bit, pay a little bit more than you'll get in a high yield savings account because of those stipulations. You're usually looking at between 10 and 35 to 40 basis points higher interest rate than you would get with a high yield savings account. So another thing to keep in mind is the maximums here. So the maximum amount that is insured by the FDIC, the Federal Depositors Insurance Corporation, is supposed to be $250,000. Now, recently there's been some doubt that's been placed on what actually will be paid out in case there's some kind of problem with the economy, or if there's a problem with the bank and it fails. In relation to bank failures, there were some prominent bank failures that occurred in March of 2023. The biggest, most famous bank failure was Silicon Valley Bank, which was the biggest bank in Silicon Valley, and they sold some securities, and there were supposed to be some rumors about the bank's liquidity, and all of a sudden everybody decided to run into the bank and take all their money out, and which caused the bank to collapse. That's called a run on the bank. So the problem was that all of a sudden there were other banks that started to fail at the same time, and the Federal Deposit Insurance Company or Corporation decided all of a sudden that they categorized the situation as a systemic risk. So I brought up Gemini, and I'm just gonna we're gonna put a little query into Gemini and ask Gemini about this, because technically you're only insured for $250,000 in each bank, but I'm going to ask Gemini what it thinks, because in reality the FDIC came out and bailed everybody out across the board. Even if they had like millions of dollars, they were made whole. So Gemini's take on this is that basically the FDIC took historic action in order to stave off like further what they call systemic risk, or they wanted to stop like a whole slew of bank failures. So you can look this up a little bit. I mean, technically, if you have more than $250,000 in the bank, you're not covered by the FDIC, but it's obviously there's a little bit of a gray area. So that's what I wanted to call your attention to, and it's just something to be aware of. And so for this reason, folks will go into different banks and have different accounts in order to have that FDIC coverage for a variety of different accounts. So let's get back to the topic at hand, which is now it's going to be HYSAs, or high yield savings accounts. So I'm going to draw your attention to the buy side of high yield savings accounts. Advantage being with high yield savings accounts that your money isn't tied up for a certain period of time. It's liquid, and you can get that rate of return no matter how long you keep the money in. So if you look at buy side here, or if you don't have the Wall Street Journal, you could pull up for free bankrate.com and pull up their best high yield savings accounts as of June 2025, right? So right now it looks like the highest available is 4.4%. And so you've got your sponsored offers here, and then you've got your hands down best rate here. It looks like it is at Open Bank, and it looks like there's no minimum balance, and you could open up with an annual percentage yield of 4.4%. Wait, excuse me, it's a minimum deposit of $500. So that's it. That's it in a nutshell. Ways to get a little bit higher return while keeping your nest egg safe, and making sure that sometimes when there's all these fluctuations and the market's going up and down and you're seeing a lot of volatility, it makes you feel a little bit better to know that your money's in the bank, and you can wake up and you're covered and there's nothing to worry about. So I'm Ken Carpenter. Thanks for watching Invest AI Savvy, and that's the way it is.